It's a single number that can decide if you get a loan, a car, or even a home. You're told it's a fair measure of your financial health. But what if the most common advice you've heard about it is a complete lie? Today, we're exposing the hidden formula and the myths that are costing you money. Welcome to the Deep Dive.
Today, we're really going into the hood of the credit score, that three-digit number. It holds so much power over our financial lives, controlling everything from loan rates to even where you can live. Our mission today is to get past the usual advice and really understand the hidden gears that make this thing tick.
Exactly. And the first, maybe the most crucial thing to grasp is what it actually is. It's not some grade on your character or how much money you have in the bank. It's purely a statistical prediction.
A prediction of what specifically?
It predicts the likelihood that you specifically will become 90 days or more late on any debt payment within the next 2 years. That's it.
Right. But because it predicts that risk, its use has really spread, hasn't it? It's not just lenders anymore.
Oh, absolutely. Our sources show it's everywhere. Landlords use it for screening tenants. And critically, insurance companies use it to calculate something called a credit-based insurance score.
Which often means if you have a lower credit score, you could end up paying higher insurance premiums, right?
Precisely. It's this kind of scope creep. Now, digging into the score itself, the biggest myth we probably need to tackle first is this idea that you have one single credit score.
Yeah, everyone talks about my score.
But the reality is you have dozens, maybe even scores of scores, and they change, constantly.
Okay, so why so many? If the big three credit bureaus, Equifax, Experian, TransUnion, are all getting data, shouldn't it be, the same score?
You'd think so, but nope. First issue. The furnishers, like your bank or credit card company, they aren't actually required to report your payment history to all three bureaus.
Oh, really? So one bureau might just be missing info another one has?
Exactly. So the data itself can be different. Second, you've got different companies creating the scoring models, the math behind the score. FICO is the big one, especially for mortgages. Like 90% of top lenders use some version of FICO. But VantageScore is also out there and gaining ground. They use different formulas.
And different versions of those formulas. It's not just one FICO score.
Right. There are industry-specific FICO scores, older versions, newer versions. It's complex. And, of course, time matters. Your score is just a snapshot. It can change tomorrow.
Okay, so focusing on FICO, since it's still dominant, let's talk about what you, the listener, can actually control. We know the big factors are payment history at 35%, and amounts owed at 30%.
Correct. Those two make up almost 2/3 of the score. But the key insight isn't just knowing the weights.
It's about the targets within those categories.
Precisely. Take amounts owed or credit utilization. That's your debt compared to your credit limits. Everyone here is keep it under 30%.
Yeah, that's the standard advice.
And it's okay advice. It's not bad. But it's not optimal. If you look at people with the very highest scores, their utilization is consistently way lower.
How low are we talking?
Ideally, below 10%. That seems to be the sweet spot for really maximizing that part of your score. It signals very low risk.
Okay, 10%. That's a much tougher target than 30%. Now, let's talk about inquiries. This causes a lot of anxiety for people. The whole hard versus soft pull thing.
Right. Let's clear this up. A soft inquiry has zero impact on your score. Zero. That's when you check your own credit score through a monitoring service, or when a lender you already have an account with does a routine review. Lenders don't see these.
Okay, so checking your own score is fine. Safe.
Totally safe. Encouraged, even. A hard inquiry happens when you actively apply for new credit, a loan, credit card. This can cause a small, temporary dip in your score.
And this is where those different models, FICO versus VantageScore, actually handle things differently, which you need to know if you're shopping around.
Yes, this is important.
If you're finding this deep dive valuable, take a moment to subscribe to make it make sense. New topics are broken down every week.
FICO is generally more lenient here for rate shopping. If you're applying for, say, a mortgage or a car loan, FICO typically groups all related hard inquiries made within a 45-day period as just one single inquiry.
So you can shop for the best rate without getting dinged multiple times.
Exactly. But VantageScore, it can be much stricter. Depending on the version, that shopping window might shrink to only 14 days. And sometimes it applies that short window to all types of credit applications, not just mortgages or auto loans.
Wow. Okay, so knowing which score your potential lender uses is actually pretty critical if you're applying for multiple things around the same time.
It really is. Now let's bust a couple of common and potentially costly myths. First one, you need to carry a small balance on your credit card month to month to build a good score.
Ah, yes, I hear this one all the time. Pay interest to get a good score.
Makes no sense, right? It's completely false and expensive. The scoring models want to see you manage credit responsibly. Paying your statement balance in full every single month demonstrates perfect responsibility.
And saves you money on interest.
Absolutely. It's the optimal behavior financially and for your score. Don't carry debt thinking it helps. It doesn't.
Okay, myth busted. Second one, closing old credit card accounts, especially ones you don't use anymore, to kind of clean things up. Seems logical, but...
Counterintuitive, I know. But closing old accounts, especially ones you've paid off and had for a long time, can actually hurt your score. Two main ways. First, it reduces your total available credit. So if you still have balances on other cards, closing an account instantly increases your overall credit utilization ratio. Remember, that's 30% of your score.
Ah, right. Less available credit makes your existing debt look bigger proportionally.
Exactly. And second, it can lower the average age of all your credit accounts. Length of credit history is another 15% of your FICO score. Older accounts help that average.
So keeping those old paid-off accounts open, even if you don't use them much, is generally better for the math.
Generally, yes. Tidy isn't always better here.
Okay, so pulling all these technical threads together, the score ends up reflecting, well, it's partly your own financial discipline, paying bills on time, keeping debt low.
Sure, personal responsibility is a huge factor.
But it also reflects things maybe outside your direct control, systemic factors. Like you mentioned insurers using it, but what about bigger economic shifts?
Definitely. Think about a recession. Lenders might tighten up. Maybe they cut your credit limit unexpectedly. That instantly hurts your utilization, even if your spending hasn't changed. Or you might lose income, making it harder to pay on time. So the score reflects not just budgeting, but financial resilience.
Resilience. The ability to handle those shocks without falling behind on payments. That's a great way to put it.
And looking forward, there's this big push towards using what's called alternative data, things like your history of paying rent or utility bills on time.
The idea being to help people with thin files, maybe young people, or immigrants who don't have much traditional credit history, right? Give them a way into the system.
That's the promise. Using AI and machine learning on this broader data could potentially open doors for millions. More financial inclusion.
But there's always a but, isn't there?
There is. The but is the potential for algorithmic bias. If the data or the AI models inadvertently build in biases based on, say, zip code or other proxies for race or income.
You risk creating a kind of high-tech redlining. Digital redlining.
Precisely. So the huge challenge ahead is making these scores more accurate and inclusive using all this new data and tech.
Yeah, without accidentally baking in and perpetuating old inequalities. Ensuring accuracy doesn't come at the cost of fairness. That's definitely something for all of us to think about.
Thanks for joining our deep dive. If this sparked an idea for a future topic, let us know in the comments below. You can continue your journey by watching the video YouTube has selected for you right here, or subscribe to catch all our future breakdowns. We'll see you in the next one.